Hello. Back again, and we are ready to stream. Most likely an hour stream. I might stream again later this evening. Recently, I've just been kind of sluggish, like bodily wise. My body's just been healing, recovering. Been a bit slower than I would have liked. There's just multiple things um, I'm dealing with, so it's been a bit difficult. But today, I'll probably have a camera on this evening, and we'll probably continue on from our studies last week. So we're currently behind schedule. It is the 21st of what's this month? April. Just any calendar would do. So we're in April, but we're in the 21st, but there's no 31 days in April, there's 30 days. So we have 1, 2, 3, 4, 5, 6, 7. We have 10 days including today, right? And we have how many episodes? 41, I believe it is. 30 episodes in 10 days. We have to do 3 episodes a day, basically. So this is fortunately 30 minutes. I think we can get through. Try to find the playlist itself. I think we can get through 3 today. Basically, we need to do 3 a day. We left off, I believe this is all part of episode 10. So on the new slide, which is going to be episode 11. Perfect. Let me find the courses. Okay, I just need to find 2022 mentorship. Do it this way. That's right there.
I take the.
Okay, so we're on episode 11. We could probably do 11 and 12. This evening we can do 13, 14, 15. And then we'll carry on from there. That's at least 3 a day, which is good. Yeah, but I want to do no days off from now on henceforth, as we are coming up to the end of the month, which is where I was targeting finishing up this program. And then maybe for the month of June, I may endeavor on a 2023 or 2024 mentorship. We'll see, and we'll go from there, basically. Right, so I want to go do a quick recap since it's been a minute. First things first, you know where we start. Use this website if you're a trader and you need a journal. It will improve your edge 100%. So far, I haven't done any updates for a while. I am working on the study journal and fixing some slight bugs. Other than that, website's in great condition. It's still available to use. You know, I haven't changed these for a while. You get to screenshot your trades, all your losses, your wins, and you know, you get to see before and after. If you upload multiple screenshots, you can see on multiple time frames. You can see analytics of your strategy or account. You can see how it's doing. We're gonna have a back testing idea where you can back test properly and actually have annotations, screenshots. It's gonna be paired with AI agents, so you can actually learn how to emphasize or to commit to your training plan. And you can see there's so much. Like I can sit here for hours, or maybe not hours, but many minutes explaining to you, excuse me, why you should get it. Try it for free, and you will then see the capabilities of it. And if it's something that appeals to you, then can get the pro version, which will allow you unlimited trades and also give you some extra benefits. That's at cedge.com. Follow that link and it will take you to this website, of which you can find in my description. Okay, so we have 10 days. We want to target doing 3 days. I think for the past 2 days we haven't done any much. This one was just us finishing episode. So did we finish episode 10? So now we're on episode 11, right? So we can get started on the recap. So recapping episode 10 is just essentially us going through the daily bias, as you can tell by the title. And we're trying to learn how to. We actually really like this episode because we spent multiple days on it, as it was very informative for us. We struggled a little bit with sometimes understanding the daily bias, especially when it can be in a range where it's like, well, I'm not too sure what price is doing. and it could be in consolidation, it could be in a weird location, but there is things you can still do. So one of the things you want to do is, in this instance, we mark the high and the low. Why did we do that? Because it's a range. When there's a range, there's going to be patterns that are going to be common to ranges. For example, you have the equilibrium, which is going to mark where price is at equilibrium, meaning that below we're at a discount, and above that equilibrium we are at a premium. Those just essentially mean this: when it's at a discount, price is cheap and it entices buyers. When price is high or in the premium, it is obviously at a expensive price, and people would love to sell. People love to sell at expensive prices and buy things at cheap prices. That's just the concept of business. So in this instance, we have a range. And if you look at this black line, oh, sorry, not black line. Black line is marking the high and the low. If you look at the black circle, we see price that created this high over here failed to create a higher high. When price came back down here, price didn't create that next higher high, confirming this in a potential reversal / uptrend. So I should say continued reversal, because this is a reversal, but it's not continued reversal because we didn't get that higher high over here. So that's what the black circle is allowing. We then also get this displacement, which also takes up this low over here, confirming that, okay, we're probably going to continue going down. And in that push to the downside, we create this imbalance right here between these red lines, which is a fair value gap. And price then comes back into the fair value gap. So yes, we're overall bearish. Like you can see, price is heavily moving down. But you can see here that when we have this indecision candle, which is a part of this fair value gap, price can very much go up into this fair value gap to then equalize price and then return to the downside. So we saw that this move up here when it took the midpoint and then the high of the fair value gap, we know that price had been delivered at these areas. And so we would expecting now from that point onwards a continuation move downwards, which is our original bias. Okay. So that's how you can utilize price action, the model itself, the candlesticks, and the balances to kind of gauge where price is going. And that's very effective because a lot of the times we're going to be in places where it's not a clean higher high, higher low, etc. So that was the premise of the beginning of the episode. Then we got introduced to the power of 3, which is left side is showing a bullish move and then the right side is showing a bearish move. This is a bar chart for a price, or price bar, I guess. I'm not sure the exact terminology, but I know it's called a bar something, bar candlestick, bar chart, bar something. Right, so these are bars. And the power of 3 is essentially going to be explained later on, but we have the accumulation, manipulation, distribution, which are the 3 parts of the power of 3, which can be found in one daily candlestick. This, once you are struggling with a daily move or daily bias, whatever it may be, this is where I would start understanding one candlestick. Once you understand one candlestick, you can then understand a succession of candlesticks. If we're bearish, and we're going to take the one on the right, if we're bearish, we cannot make a big deal, is what I've written in my notes, when we have a price or a week, for example, of consistency in bearishness, and then within that week, we have 4 or 5 candles are bearish, 1 is bullish. Does not mean that because we have that one bullish candle, the bias is invalid, nor does it mean that we have that one bullish candle in the bearish market, it means we've failed. It does not mean that we don't know what the bias is. It does not mean that it is prices against you. Okay, it's a part of trading. Those are things where you're not going to know exactly when the price is going to go up or down. You just want to play the odds. You want the odds to be in your favor. And that's one of my favorite analogies with trading, is that you are the casino and the markets should be the retail traders or the customers of a casino. The thing about being a casino is that, yeah, sure, you're still gambling. The difference is that you have the edge and the odds in your favor. Low probability states that over time you will win more than you would lose. Therefore, as a trader, we need to get as many things as possible in our favor, which is why we have our trading plan, which is why we have our win rate, so we can know, are we the casino or are we the customer? And with good risk management, you can be successful. So that's just more of like a mental kind of note. And this is the exact same move that we were looking at earlier, which is over here. You can see the fair value gap here, but we're just looking at it now on the bar chart form at. And the reason why we're doing that is just so we can grasp more so the understanding of the power of 3. But you can see it's the same thing. We have price open here. It closes above here, but doesn't fully take out the high. But the next candle does. It opens. It pushes up, pushes down, comes back, and then closes here. Then we have price that opens, accumulates a little bit, and then distributes all the way down here. So I've used some key terminology, which is what we mentioned earlier: accumulation, manipulation, distribution. Now it's key to go through all of them. Now I like to start with, I'm actually going to rearrange this, and I'll tell you why in a second. Because you get manipulation first, which is a portion of accumulation. Once accumulation happens, completed, you then get distribution. And it also spells mad. Okay. So manipulation is the initial run up, which is this initial run here, which is the Judas swing. Remember, we're in the bearish market. So if we're in the bearish market and price moves up, that move up is a false move. Okay, so it's there to trap buyers, to gain liquidity, and to, of course, accumulate the shorts for smart money. So all the things that are happening within that initial run up. So the manipulation is that initial swing. We open, and the area above it is an accumulation of shorts. Bear in mind, we are obviously talking bias, bearish bias. The opening range is this area from the open to the top, which is the high, and that distance that we have, which is the manipulation. We take that distance, apply it from, you can see this is from the open above. We now apply it from the open below, but the distance is the same. So we just essentially are splitting this in half and duplicating it down here. So it'll be from this high to around about here. Okay, we're kind of simulating this length from the open to the high downwards. And that is the accumulation. That is the accumulation of all the short orders from smart money. Okay, and the accumulation, we see the patterns of the accumulation. We've talked about the market structure shift, the imbalances, all these types of things, the strong move, the confirmed market structure shift, and the things we look for in the market structure shift that makes it a market structure shift. All of those things are important. So that after the manipulation, accumulation, we then have price deliver down here, and it distributes its orders down here. If you're selling high, you need to find buyers at the place you want to sell, because when you're selling, you're essentially buying price up here and then buying it down here. And what you're doing is that you're buying it from sellers. So let's say there's a product and it's $1,000 up here, 500 up down here. You're buying it for $1,000 because you know that it's too expensive. So guess what? The price is gonna go down. So you buy it at this price, and everyone is getting rid of as much as they can. Why? Because the price is high. So people are gonna sell it all. And then all these £1,000 things are going. And eventually there's not enough sellers or buyers, let's say. And then since there's not enough buyers because it's so expensive, pricing drops to try and meet that demand of buyers, right? And price keeps dropping price, but it's not enough buyers. And then eventually the people that bought 1,000, they then buy it back at 500. And what's essentially happening is they are buying here and essentially selling here. But the thing is, they are, because the reason why I say buying here and not selling here is because if price goes up, you're selling something for 1,000 and it goes to 1,100. You're not actually losing that 100. But if you bought for 1,000, you've spent, it's like a short. You're buying the hope of it going down. So if it goes up, you're losing money because the execution or the distribution is down here. This is where you make profit. I don't think I really explained that well, but that's essentially how I view it. And then distribution is essentially where you, obviously, if you're selling, you then distribute it to the people that you're selling to down here or buying from down here. Okay, cool. And the lower of the day, there's an important side note. The lower of the day is down here, but the close of the day is generally speaking close to the lower of the day. We can never really always get the exact point of where the low of the day is, but we can gauge, okay, the low, since it's generally formed around the time of the end of the day, you can see that a lot of the times we have the low and the close very close to each other. Wait for bearish. So you see the low down here, just above the arrow that I'm using. Right here is the low, right here is the close. You can see the distance is close. Right here is the low, right here is the close. The distance is close. Not every time, but sometimes, right? And so because of that general rule of thumb, we can then either target to take trades out by a certain time and or by a certain distance. By that, I just mean like your risk reward ratio. So we're now looking at the overall move of a chart here with the bar format of the candlesticks. Right. So in this part, we're just looking at an overall move, and the main reason why I like this is because you can see prices just utilizing the power three consistently right after the other, and that's kind of a move where you can be profitable. But starting with this red circle, we are circling this area because we see this candlestick here, we see this candlestick, this candlestick, this candlestick. The thing we notice is that from this imbalance here, price just keeps dropping, right? But what you'll notice over here, something changes. You can see low, 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 low. That when I say low, it's lower than the last low. So low, lower, 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 but higher. Now, this is the first time we've seen a candlestick that's higher than the previous one in this kind of downward trend. I think this is the daily candle time frame as well, so that's important to note. Wait, oh, there we go. Okay. So we see the swing low formed because we have the candlestick before it higher, the candlestick above it higher. Therefore, this is the extreme because there's nothing that comes close to either side of it, confirmed by that fourth candle. Also, this fourth candle well, not shows, but kind of hints to that this is actually a valid swing low since it didn't take out any of the previous lows. It just went higher. Okay, so this is kind of pushing off from the point we made last time that when you're determining the direction, you can utilize multiple things. You can utilize price action. Excuse me. You can utilize price action. You can utilize the model itself. You can utilize liquidity. You can utilize imbalances other than fair value gaps and all these types of things to kind of help you gauge where price is going. And the reason I say this is because we can break that down here, that we have a fair value gap here. We have a swing low here. We have price action showing that, okay, well, this swing low is confirmed. So from that point on, we're bullish up until the fair value gap. So what happens? Price then pushes up, and then it retraces a little bit, goes back down here. Then guess what? Price then distributes all the way up here, or delivers all the way up here. But there's important things to know that because we're bearish, like a lot of times we don't always have to get the exact, we can't predict every day, right? So sometimes, even though we have a swing low here, we may be on this day right after the swing low, we could be bearish because what's happening before? Low, lower, 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 lower. This is higher, but let's say this ended. I'm going to be at this point still bearish. So this day where price pushes down and goes all the way up and closes here, do you know what I'm going to do? I would have taken a loss that day because I would have been thinking that this is going to continue itself. Low, lower, 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 right? So as soon as we then get this bullish candle, the reason why we then alter into this bearish move, like you can highlight this is a bullish move and it traces back to this point. This is, you need to find out, okay, this was bullish, this is bearish, what happened? And you go and you see, okay, this is still bullish. Why? Bearish. Why? Because we're getting lower lows, lower lows, lower lows, lower lows, lower lows. But then right here, there's a turning point. Why is this a turning point? This is where we're interested in. And then we seize the turning point because this is a swing low, which is confirmed by this candle being higher than the previous candle and this candle being higher than the next candle. So it's an extreme made, number one. Number two, we then see on this day right here that it didn't form a lower low as opposed to what it's been doing for the past maybe 1, 2, 3, 4, 5 days. So we were taking loss here, but guess what? We're now bullish. And why are we bullish? Again, context. You also have the model itself. You have the imbalances or the external liquidities, etc. We have a fair value up here. Price wants to rebalance the markets. So when price is pushing up, you can see here it comes back to the midpoint, retraces, but we didn't take out the upper limit. And what happens? We then retrace down here, and then price then takes out that upper half of the or upper boundary of the fair value gap over here, which is this blue circle right here. I think that's meant to say rallying. Wait, what happened to the blue circle? Wait 1 second. All right. Beg your pardon. Right. I'm not sure this blue circle, I'm not gonna lie. I think what it's trying to say is that if you look at this candlestick right here, you can see that the low and the low and the open is quite a big distance. And that is a strong accumulation before we then end up rallying upwards. So we need to accumulate before we deliver and then distribute. And after we'd cleared the upper boundary of the fair value gap, we then target this external liquidity over here. Remember, we don't have a swing high at any point in the moment in this time. Maybe around here you could maybe start to think. But what happens is just consolidation. But prior to that, what do we notice? We notice that there's a long candlestick right here, which is the power 3, remember? We are utilizing the power 3, and that power 3 is showing us that there's a strong accumulation, which is a sign that price could go up. So we're using all these different things essentially to try and find out what way price is going. And all we have to do, like I said, is the casino analogy, is to try and get the odds in our favor. Okay, this is another example. I think it's the last one, right? Yeah. Okay. So another thing to note, which I almost forgot when I first listened to this, when we see the power 3, it's careful that we start from midnight New York session open, which is about 8:30 a.m. now for GMT. No, wait, they're 5 hours ahead, aren't they? So it would be 5 a.m. GMT. So what we need to notice is that the power 3 is, remember, it's related to the daily bias. So it's what? It's a daily candlestick that we are utilizing. We're utilizing on the daily time frame, essentially. And so when that happens, you have to be making sure that you are looking at the markets with the from the midnight hour of New York session to showcase the power 3. Because when you do that, you can then see the power 3 play out, the manipulation, the accumulation, and the distribution. But you need to start from midnight. Okay, so we start trading from from 8:30, round about here, I believe. Let me zoom in a little bit. So wait, it'd be maybe round about here. But we've had the open, the rally up, which is a manipulation. Have a displacement here. We push back up into this area, of which you probably could have actually got a selling order in, because your low or your stop loss would be above that high right here, because that's the first candlestick towards the fair value gap. On a 1, 2, 3, it would actually build it up here. That's the 1, 2, 3 candlesticks. You have an imbalance here. This high right here, the high of it over here. So you wouldn't have been stopped out. Then what else you notice? You then have another entry, because we come back up into that order block right here, and then we push to the downside. This also had market shorter shift as well on the smaller time frame. What was time frame? This is 15 minutes, I believe. Okay, right, and then boom, boom, boom. What do we have here? 1, 2, 3 in fair value gap. Our stop loss would have been above here. You had it here, and you wouldn't have been stopped out, because you would have got in right here, stop loss over here. You kept going down, and you still have multiple opportunities. There's a fair value gap here. To be fair, we didn't actually come up into that entry, but there's a fair value gap here. We push up into it, and your stop loss would have been over here. So you would have had 1, 2, 3 opportunities to get into this one move on one day, as you can see from here. So this is using the power of 3 and the daily bias to help us. If we were to start trading about 8:30, which is around here, and we look at just liquidity in general, we'll be waiting for price to sweep this. You then also have like sell side liquidity here. So we sweep this. Well, liquidity here. So hold on. I'm trying to look at it from objectively. Okay, let's move on. It's been 30 minutes.
Hi, folks. How you doing? Hope everybody's doing well. And this is just a kind of like a prep to get your mindset correct on what's coming in 2 days on the YouTube channel. I want you to understand going forward that obviously you all are familiar with my moniker. I've dubbed myself the demo baller, and I've always talked through the medium of a demo account for my own protection. And I've had students come into my fold and question whether or not it was something that could work in live accounts because they themselves couldn't make it work in either a demo or pre-trading, because either they could not find it in themselves to submit to the process and the time required for their own individual development, or they rushed and did things foolishly outside of the instructions that I provide in mentoring. So there's a small faction of individuals on the internet that believe that these things that I teach don't work in a live account. And it's never really been an interest in me really to see people fall over me and believe everything I say. I've challenged everyone to put the things I teach to test. See if the things I'm teaching you are in fact in the marketplace. Do they deliver more times than not? Does it provide you a way of finding consistency over a week? Not every single day perfection, because I can't provide that. I don't even trade perfectly like that. No trader can, no teacher can provide 100% accuracy. But the way I teach and the way you'll see me mentoring on this channel in 2 days is I take the yearners. Okay, all of you that are not trading yet or have tried trading and failed, you're yearning to learn how to do this. Okay, so I'm teaching with that mindset. Now, some of you obviously may have already been with me and found some consistency, and some of you are doing exceedingly well, and that's amazing. That's great, and I'm thankful for all of that. But this is really meant for, specifically, it's for my daughter. Okay, so I sat down and figured I'd kill two birds with one stone, and if I can show a simplistic way of going in, using the things that I teach, stripping it down to its chrome. Okay, no bells and whistles, no advanced theories or anything like that. What can I do to provide a model that my daughter could look at and say, okay, there's not a lot of moving parts. It's real simple for me to decide what it is I want to do, and also when not to do something. Okay, and some of you may already be completely upset with that idea because you want me to come out here and lay an arsenal in your hands of high-tech weaponry. It's been my experience that the highest form of analysis concepts that I've been teaching in my own personal mentorship many times creates exceptional traders, yes, but the majority of them, and them being my students, they get bogged down in all of the content, and it just creates analysis paralysis. And it's just too many things for them to decide because, like in the candy store, what do you eat first? And while you're still chewing on the first thing, what are you going to reach for next? Okay, so if you don't have discipline, and this is a personal responsibility characteristic that all of you are going to have to really assume, okay, because I can lay the things in your hands, but if you don't respect the fact that they have sharp edges, okay, or if you use live ammunition before you're really properly trained, you could hurt yourself. Okay, so with that idea in mind, I'll be teaching a stripped down version of my concepts in a mentorship style, so that way you can go through the process of learning how to do a specific trading model. And I'll keep things germane to that model, not trying to bring in too many things. And one of the approaches is to trade it with index futures. Okay, and if you are not interested in trading futures, that's fine. You can still trade Forex with these concepts as well. But I kind of want to drive it with futures. I actually began trading in 1992 as a commodity future trader, and I moved away from grains and cattle and gold, silver, crude oil, all those types of markets, and moved into the bond market, the 30-year Treasury bond, and the S&P. So when that became my cup of tea, if you will, I became a better trader intraday. And I put down the pursuit of trying to be a long-term position trader because I felt that that would be the best thing for me, because at the time I was working a job and I had to balance all those things like working class individuals need to do. They have to commute back and forth to work and those types of things. So I figured position trading would be the thing for me, and I found out that it didn't work for me. Okay, so I liked the idea of short-term trading, intraday trading. It made sense to me because I can make quick decisions. That may not be your style of trading. I will teach you how to apply the things I'm going to teach on the YouTube channel, how you can scale that up into any time frame. So that way there's no excuse for you not to be able to use the information to at least better your understanding in price action. Okay, so here's my promises to you. I promise you, you're going to learn things that absolutely repeat a lot. You are not going to be perfect. It's not my goal to make you a perfect trader. It's not my goal to make you a perfect analyst. My goal is to improve your understanding about price action, how price is delivered, and how to read the bias on an intraday basis, a daily basis, and hopefully over a short-term period of time, you can find setups that repeat. And they have common characteristics that are very similar, but they won't be identical. No, they won't be carbon copies, but you'll see similarities to know and trust that this is a setup that you are familiar with. Okay, and because you are all being viewed as yearners, okay, you are all yearning to learn how to do this. There's 3 stages in this YouTube mentorship. Okay, I'm treating you all as greenhorns. Okay, you're just yearning to do this. A lot of you that begin this YouTube mentorship will not complete it because you're going to get frustrated because you want something else or a alternative way of me teaching it to you. I'm not going to take suggestions from anybody on how to teach it differently. This is the way I'm going to teach it, so it's as is. It will not be setups given to you for trades, but I will take your attention before the fact and draw them out on a chart where I want you to study, where price will likely draw to next. And using the things I teach you conceptually, it's your job to study that. Okay, do not look at that as a trade setup. Do not look at that as an enticement to take a live trade. So it's my intentions to take the yearners that want to learn how to do this through a process of becoming structured learners. So you're going from yearning to learning, and hopefully at your discretion and timing, you'll become an earner. Okay, so yearner, learner, earner. Okay, so those 3 stages are what I'm going to take you through. It's not going to be an entire year mentorship. I'm only going to do probably 3 or 4 months. But before we get into it, I want you to know that I will not be providing any content to the YouTube channel or my own personal mentorship during the month of March. Okay, so March 2022, I will not be doing anything. I'll be on vacation, and we're going to be doing several road trips. So I will not be working for you. Okay, so if you can accept that, then I think over the next coming months, it should be rather entertaining and interesting for you as a student. So you're looking at this screen here, and one of the things I promised I would do in 2022 is to show you how some of these concepts would work in an environment outside of a demo account. I've always used the moniker demo baller because that's my name. I gave myself that to kind of like champion the idea that I'm teaching through a demo. But if I can teach you through a demo and things are repeating, you can see your charts. Okay, whether it's a live platform or if it's a demo, you're seeing the things that I teach. And if you've been fortunate enough to be in my presence when I'm calling it beforehand, it's very rewarding. And you all on YouTube will have those experiences as well. But the main thing is for you not to grow a dependency on me pointing to everything before it happens, because if you do that, or if you have that mindset going in, it's going to stunt your growth. And in fact, it's going to create a barrier for you because it'll create a codependency state of mind. And I don't want that. I try to foster a independent mindset where you're independently coming to the decisions on your own. So that way the results are yours. If it's success, you own it. If you failed, you own that too. I can't co-sign for your failure. And some of you absolutely will fail. I've said this many times openly and every time I've been asked. In 2016, I started a paid mentorship. And I have students from that time period that are still trying to find their way, and they cannot make these things work for themselves. I have other students from 2016 that are absolutely mind-blowing results. And I have students from my mentorship group. It was the final class in 2021. I'm not taking new enrollments, so don't ask. That group, I have traders that are doing very well as well. So it's not a shortcoming on what it is they're being taught. It's just an individual, unique experience that you have to grow and go through. And I can't speed it up for you any more than I already done. So I'm optimistic, but I'm a realist. I know some of you simply will not do the things I ask you to do. You will not do them effectively. And you'll try to shortcut certain things, and you'll think that you don't need to do this and don't do that. And your results will be reduced because of that. So if I suggest things to you, drills, homework, things to study, do your best to participate in that. Okay. And even if you can't do it live, there's other ways to go through and look at it. It's not the same as seeing it live, but it's the best you can do, because some of you have businesses, some of you have school, jobs. Okay, let's be real. You may have family things that keep you also from being able to watch live data in the times I'm asking you to do it. I'm not going to jump through hoops. I'm not going to do acrobatics to make it feasible for every single one of you. Okay, it's unrealistic for any of you to have that expectation of me because I don't need to be doing this. I love doing it. I'm looking forward to doing it, but I want to make sure all of you have the right mindset. Okay, so in 2022, I promised that you would see how these concepts work in an environment outside of a demo account. And what would that mean? Well, it would mean not an MT4 platform, because years ago it's been shown how frauds and banks can use that platform to pretend that they're profitable, that they can find setups, and that their trading is amazing, and they can go in and edit their trades after the fact, after the market's already moved. Well, I've already proven that I don't do those types of things, and I went to TradingView, and that was the platform that I asked my community. So which platform should I use? If I'm going away from MT4, I want to go to a platform that's reputable. So I teach, and you'll see me teaching through TradingView. So that's the medium that we use. It's familiar to me because I'm teaching mentorship students through that. But if that's not your platform of choice, you're just going to have to get used to me teaching through that medium, because I'm not going to do something in addition to. Okay. But for a live account, I felt that TD Ameritrade is very reputable, and that it is regulated by the Commodity Futures Trading Commission and all of the other governing bodies. I cannot rig this to make it look like I'm smarter. Okay, I can't go back in and change a trade. I can't fix it. Okay, I can't add lipstick to it. Okay, it either is or isn't a profitable trade. Okay, it's simple as that. TD Ameritrade uses the margins that are accepted and established in the industry, and some of you may not be able to trade a market because of margin. Don't let that be a hindrance. I'll show you how to work around that in other platforms. While I don't personally use an MT4 account for teachings or trading live funds or anything like that, I'm confident that students that are trying to learn how to do this, they can still use MT4 or MT5 or any other platform for that matter. I, as an educator, though, moved away from those platforms because they can be gamed. Okay, in other words, they can be used to fraud and fake results. Okay, so in TradingView, you've seen examples after examples of me going in, recording an entry, calling the moves as it happens without the replay button, because replay doesn't let you do trade entries. Okay, and replay only shows you a completed candlestick. It doesn't show you the generation of the open, all the price action up and down to the close of every individual candlestick. So I had a lot of folks over the years ask me to show live account, show live account, show live account. And one of the things that kept me from wanting to do it is because if I show results of any kind right away, and this is how I viewed it too as a developing student in the 1990s, that made me feel like I'm never going to get it, because their results were way above what I could do as a learning, developing student. I had no idea what I was doing in 1992, but to see people say, yeah, I made $50,000 in the soybean market, okay, or I made $80,000 in coffee. Well, that to me was a very huge mountain to climb. Like, I have to do that. It felt impossible. But I also didn't want to give results that were so low end that it didn't inspire an interest in having people want to learn it. So because this business is extremely unique and personal, it's both the easiest thing you'll ever do, and sometimes, for many of you, is the most impossible thing to be successful at. And that sounds like an oxymoron. It sounds like double talk. And it is, but it isn't. How's that for a ribbon? You can't appreciate how difficult it is until you start trading with my funds. But before you start trading with my funds, and you're in the consistently quote unquote profitable demo trading stage, you feel like you can do anything. But something magical happens when you go into a live account, where now suddenly every little tick means something to you, because it means success or failure on an individual basis. Whereas if you lose in a demo account, you didn't really lose anything. You can take another demo trade. But with live account trading, you have to deal with that drawdown and that loss. And making money in an account is sometimes worse than losing money, because it'll make you feel like you want another taste of that, and it creates opportunities for you to go into a trade and or over leverage. And both of those things we'll talk about in the YouTube mentorship, how to avoid some of those things. But it's up to you to avoid them. Okay, and it takes a lot of ownership personally, and the responsibility that is required to do this is paramount. Like, you cannot have anybody else take responsibility for your actions. It's your actions, and if you do well, you earned it. If you don't do well, you have to eat it. Okay, it's the way it is. And too many people are weak-minded in this world that they will never become successful traders. No matter who teaches them whatever thing they use, they're going to be a failure. Okay, that's just the way it is. And there's no way around that. I can't fix and improve everyone's shortcomings. I have my own personal issues that I fight and wrestle with internally, and it's not easy. Like, I'm obsessively compulsive, and I have ADD. It's all these things, okay, that make it difficult for me. And I'm bipolar, so I have a lot of mental barriers. But if I can sit down and frame out an idea that repeats at least once a week, I'm confident that those individuals out there that are like me or without these barriers can do it as well. That's my personal belief. It doesn't make it fact. It doesn't make it true. It just means that's my belief. And I've seen case studies in my own students where that's true. It's a transferable skill, but the skill must be honed by you, the student. So anyway, I promised I would show some results in 2022 outside of the demo account. So I used TD Ameritrade, but years ago I was asked to show a regulated broker, non-MT4, and I felt that TD Ameritrade was a better choice outside of the standard Forex account brokers. Because with TD Ameritrade, you can trade Forex, you can trade futures, you can trade commodity stocks, options, you can bond, everything out there, you can trade it. Okay, so eventually over time, if you do become successful and you're profitable, you want to go with a broker that allows you to have access to all those vehicles, because there are certain times of the year, certain asset classes just aren't going to do very well, but others will. And that's the type of broker. And I'm not repping TD Ameritrade. I don't get anything for it. I'm not an introducing broker. I'm just saying that when I'm showing results in an account that is not demo, this is the broker that I deposited funds with. So that way we know what I'm saying here. I'm not telling you to go here and trade. Okay. I have only traded a few trades with this broker, but I can tell you their fills are immediate. The confirmations are solid. I haven't had any problems technically. It's just I'm fumbling with the layouts, the way things are made available to me, because it's just like anything else. When I'm transitioned from MT4, teaching from that, being very comfortable with that, going into trading view, it's just very cumbersome, and I'm still clumsy with it when I'm teaching. And I'm finding it a little bit cumbersome here as well, because I just don't know where they have certain things. I don't know how to make the charts scalable as fast as I want them to be, and like I'm used to doing it with TradeStation or TradingView or MT4. So it's just a learning process, but it doesn't change the fact that if you know how to trade, then the trades are easy. So I keep everything very simple. I use limits and markets to get in, and I just class the trade when it gets to a target of my choice. So that's all I'm showing you here today. It's just to show you that things I'm going to be showing you are applicable on paper and in demo, and the same logic is used here. And while this is not a lot of money, it's only $23,694.11. It's not something to brag about, let's put it that way. But it's something that's not demo. It's something that won't stay at that level. And my objective is to teach conceptually a hypothetical income-based strategy. Okay, it's not a trying to beat the World Cup. Okay, it's not trying to do better than every Instagram trader out there. It's just trying to teach how someone can take another opportunity, and hopefully in the best case scenario, and I can't guarantee or promise it to you, but I'm going to certainly do my best to do what I know and how I can teach it, so that way you can be at least inspired to make an attempt to try. Okay, and because I believe that things are about to get really, really hard for everyone financially, and without going into great detail, just look around the world and you know what I'm talking about. But this is the EMA S&P March delivery contract for 2022. Okay, and it's a 2-minute chart, and I want you to see the port of entry here. This is a short it took, and the cover was here, and another one here, a small little scalp, and here, and then over here, I'll show you so that we can see there's no other trades after that short, or 2 shorts rather. And today I slept in, and I just want to have something in addition to what I already have here. This is kind of like one of the setups that you're going to learn in mentorship, where the entries here and exits here. Okay, not a lot of handles. Okay, handle would be like 45.67 to 45.68. So that's 4 ticks for 1 full handle.
I'm just thinking, this looks like the one we were looking at, because we have this swing low, fair value gap. I use this one, but I'm seeing one like from larger time frames. This is the 2-minute fair value gap or something here. We didn't have low, swing low, break out previous high. Confirm this extreme point, push upwards. Anyway,
this market is $50 per handle, or per 4 ticks. So every 1 tick is $12.50. Above this high is buy stops, and I was targeting that here, running into that. Okay, so very, very simple strategy. Option trade entry. You don't need to get in at this level here. Okay, I'm going to teach you how to have forgiving entries. You don't need to be highly precise about your entries, but you need to be precise about the direction of bias and where it's going. Okay, where's price reaching for? And that's kind of like what I'm showing you in this mentorship on the YouTube channel. So if I have at least given you the opportunity to find setups conceptually, if that's the case, then over time, if you submit yourself to it, you'll find more setups than you've ever imagined. Because they're there a lot in just some of these lower time frames. So in a nutshell, what am I saying here? I'm saying that if you can learn how to take 25 handles, okay, you can take 25 handles out of a market like the E-mini S&P. You may not have the margin, $12,000, $13,000, whatever it is, to trade one contract of this market. You don't need to have that. You can trade the micros. And while you're not making $50 per handle on E-mini S&P, you're making $5 per handle. You can still graduate over time and build that up. And it's not a lot of initial margin that's required to do that. Or if you're outside the US, you can trade a CFD and trade the US 500 market through like an MT4 account. And again, I'm just going to touch on that. I'm not suggesting that you should trust those individuals in the States because it's actually illegal for you to trade that because it doesn't go through a regulated exchange like futures market would. So that makes it illegal for U.S. traders to do that. So we have to, in the U.S., trade through the futures market. And they have been nice enough to provide micro accounts for vehicles like the EMA S&P and the NASDAQ. They have micro accounts. So whatever the multiplier would be on the regular mini, it's just reduced to a smaller level in terms of margin and tick value. And I'll cover all that stuff. I've made it very, very simple, or at least that's been the goal I'm having going into this. I've made it very, very simple for all of you to look at it, say, okay, I don't have to have 1,000 moving parts. I can go in and simply look at things that make sense. And if you can visually understand what it is I'm teaching, you'll see that it doesn't require a lot of chart graffiti, okay, things that are very distracting. Do you look at this chart here and see a lot of things that would be mysterious? No, very simple little things. I'll draw a line to highlight a level that I want to see breached, okay, and a level where I want to see it reach up into. And that's the basis of understanding how the markets work within a liquidity matrix. You have buy side and sell side. And once you have that understanding, and I'll teach some of those things in the mentorship, you'll be able to find setups that we can, at least one good setup a week. But if you can find 25 handles a week in the E-mini market, you can do very, very well with that. Very, very well. You don't need to hit home runs. And here's my inspiration to you in closing. If we're looking at a market that provides us setups, and let's just say your mortgage or your rent is, say, $1,500. It may not be that much. It may be actually more than that. But I'm just going to say, let's just say it's $1,500. What happens if you can earn enough to make 50% or all of that a month going forward? Would that not be beneficial to you? That's the mindset I want you to have. Or let's say you have a car note and your car payment and your car insurance. If you could find a way to have that money come to you by your own speculation over time, not right away. I'm not suggesting all of you are going to be able to do this in the same year. But over time, if you submit the process I outlined for you, my belief is, my personal belief, my honest opinion is I believe that it is possible. Now, anyone can say, oh, anything's possible. But I believe the things I'm going to show you are things that you'll be able to spot on your own. Now, I'm going to coach you throughout the coming months, showing you where certain things may deliver. But I don't want you to feel like you need that. So I'll teach you how to anticipate certain things on your own, and then you check yourself with the things I reveal or do a review with. And my belief is that you'll be better at reading price when I'm done doing this YouTube mentorship. And again, I don't think I'm going to be doing more than 4 months, and that 4 months is actually including the month of March where nothing's getting uploaded, nothing in my private mentorship or on YouTube. So I'll be vacationing that entire month. So I'll be doing those things during the month of March. And in April, I'll return back to the mentor that I am in my private mentorship, and I'll return back to the delivery of the lessons on the YouTube channel. So what does the schedule look like for this mentorship on YouTube? Obviously, Friday will be your first episode, and then it'll be a Tuesday and Thursday upload. There will be assignments and PDF files provided for your learning throughout the week. I'm not promising any schedule on that, but you'll be able to see them if you go to my community tab. I'll provide a way for you to get to the information and download it. And I think that if you submit to this, you'll be far better than you are right now about reading price, expecting certain things to deliver, and you'll find that it's not as challenging when you have a good mentor and you have sound logic, and it's not overcomplicated. And that's my goal going in. And until I talk to you on Friday, be safe. Listen to what I gave you in terms.
I'm just going to not write anything down for that. I'm going to go straight to episode 12 here.
All right, folks. Well, we're here. So technically, this is the first.
Wait, was that even episode 11? I've been trolled. I just listened to episode 1. No wonder. Oh my gosh, bro. There's no way.
A little bit earlier broadcast today. I have some plans this evening, so I want to get out of the way. All right, so we're looking at, obviously, a hindsight view of something I pointed to before it happened. So that way you guys got a chance to see what it was like for my private mentorship group. When I say these things, it's almost like an invitation for some of you to email me to ask to join that. You can't join it. Okay, I'm teaching mentorship on YouTube. Okay, so that way you don't need to reach out to me. Okay, I'm teaching right here, and you didn't have to send me any credit card information. You didn't have to set up any kind of PayPal account. There's nothing to worry about. You either watch it and enjoy it and get something from it, or you never come back and watch it anymore. Okay, it's very simple. But I'm getting a lot of feedback from comments, and it's been very positive, so thank you for that. It's very encouraging. All right, so we're looking at the E-mini NASDAQ futures contract for the March delivery. If you remember, I was outlining this imbalance in here. Okay, and I gave you the high of this candle, the low of that candle, which it should be sitting right on that. So with this imbalance, we traded down to a discount, back up to a premium. Again, measure the high to the low, and I'll do that for you now. So you're like, can you just do it for me? All right, so here's 50% of equilibrium inside this dealing range high and low. So we traded from these lows up into a premium above 50%. Below 50% is a discount. Here we tried to rally up above this high, failed, broke back down below 50%, and created a gap. Okay, so it comes up back into a premium market above 50% and fills in the gap. I mentioned how this type of retracement can lull traders into likely thinking it's going to go higher, but we're thinking down here. Okay, the liquidity resting below here is what they're going to attack. So all of this consolidation just sets up another selling opportunity to run down there. And again, you're welcome to go back and listen to the previous discussions, and you'll hear me basically say that we're going down here. All right, so it needs to rebalance this first, and it spends 3 days in that range. Notice that? Then it releases the downside, attacks the sell side here, and trades into the sell side liquidity resting below here. So let's go into a lower time frame hourly chart and ferret out some more information and details. All right, so here is the hourly chart. You can see that high end of the fair value gap and the low end of the fair value gap. We traded up into that, sold off, consolidated, sold off once more. And you watch me share on the community tab my live trades from yesterday. It was traded through TD Ameritrade. It was not a demo account. Okay, so I'm going to go into what I used, what I saw, and then obviously I'll show you in the account where the details were. Okay. All right, so the market started trading, rallied up, took out a short-term high on Friday. See that? Then it started to break down. And then overnight I was watching this, but I was hoping that it didn't take out that low before the morning. I wanted to see it trade up here, take that high out, and then consolidate after running below that short-term low. I didn't want it to be in a hurry before the New York session in the morning, because that would set up a nice short up here where I could have taken a run under this low and then see if I can capture a re-entry, which is the entry you'll actually see me do. And then the drop down in here. Now, Monday was a bank holiday, and trading stops at 1 o'clock in the afternoon on holidays generally. And resumes around 6 o'clock in the afternoon New York time. And when we stopped here, we had already moved aggressively lower and stopped right there. So I felt very strongly that we were going to gap down below it, and it gave us a beautiful gap lower and run immediately. But I was looking at the 13,590, 13,586 level real time, and I couldn't get to my screen fast enough to close it out there. And I didn't want to put a limit order in, because if it gapped really far down below and started running really lower with a lot of speed and such, I didn't want to limit my profitable exit with having a limit order in. So I just left it open-ended, and I wanted to see how far I would reach down in there. By the time I closed the trade, it closed me at 13,612 and a quarter. So my entry was 13,858 and a quarter. The exit was 13,612 and a quarter. That's not a little bit of ticks, okay? 240 some plus handles. So you take that 240 some, times that by 4, there's your tick value for those that like to keep counting them. You're going to drop down into a 15-minute time frame. All right, so we had that run on Friday's high here. Started to break down, and at 10:30 in the morning, 10:33 was the actual fill. So it's right in that candle, right in here. I'm trading in that candle, going short. So we're going to go into the details and look at why that was the case. And again, you'll see the live account log in the business. Okay, so just hold on to your horses if that's the attitude you have right now. Oh, you in hindsight. So we're going to go into a 5-minute chart. Start going down into the details here. Make this a little bit taller so that way you can appreciate the imbalances that are being shown. All right, so we had this rally up, which in my mind was acting like a Judah swing in the morning. Okay, so here's 8:30. It starts to run higher. So I want to be in going short at this candle's opening, and you can see that. Well, maybe you can't see it. The opening price over here. Okay, here is 8:30's candle right there. The opening at 13,798.5. So I want to be preferably going short something above that price. Okay, so I'm anticipating further weakness. And before I go any further in this one, I got several people, probably about half a dozen or so, mentioning their confusion with why I mentioned the opening price at New York at midnight and then the opening price at 8:30 in the morning. There's 2 reference points being specifically dealt with there. If you're looking at the entire daily range, you're going to use the opening price at midnight. But if you're going to be looking at the morning session, you're going to be looking at the 8:30 in the morning opening price. Okay, so I hope that's made a distinction there. Don't worry, I have a market structure lesson coming up on Thursday that will further solidify and remove all doubts and concerns about that, okay? But for now, let's just go through this one. So 8:30 in the morning, the opening price, I'm bearish. I'm thinking we're going to go down below that green level there. That's the old daily low. So on this candle here at 8:30, I'm expecting all this being a fake rally. It's something to lull in traders to chase it going higher. The retracement, people that don't really understand order blocks are going to say, look at that, it's a down closed candle. I'm going to buy that. And then when it starts to go up like that, they feel, wow, this is really easy. Every down closed candle after a run up is a bullish order block. It's not. In here is the real context. Okay, we have an imbalance there, and that's what I'm looking at. I'm looking at this imbalance right there. So I'm trying to operate inside that range for a short. Now, I know because of the volatility, it can color outside the lines, and it's okay. The bodies of the candles are kind of supporting the idea of what I'm looking for, but the wicks I could care less about because I want to get in when it's ideal. And I'm going to show you what that was looking like for me at the time. So we're going to drop down into a 4-minute chart. Okay, so here's that imbalance and fair value gap on the 5-minute chart, but now it's a little skewed because it takes up 2 candles to show that range. The market trades up, and right in that candle, that one right there, that's where I'm going short. I got in at 10:33. Okay, that was my short. Dropping down into a 3-minute chart. Okay, the market trades up, works inside that imbalance, and right there, 10:33, that candle, when it's starting to bump up against the top end of that fair value gap, right there, as it hits that and starts to move away, I'm in there. I'm going short right there. The reason why I'm trusting that and not thinking it's going to go higher is because we have this high here, okay, and then we have this high here. Which high is higher? This one or that one? Obviously this one. Now, this candle's high. Watch what happens. From this high, we have a short-term swing high next to it here, and then we have one here. So this one makes a intermediate-term high. So we have a long-term intraday on a 3-minute chart, which sounds like a lot of people want to know, but long-term high, intermediate-term high, because this high is lower than that one. But we have a swing high here and here that are lower, both being lower than this one. Then we have the same context right here. We have a high with a lower high on
And
either
like
side.
heads and shoulders.
So I have market structure behind me showing that this is, number one, it's a bearish market because my draw on liquidity is down here. It hasn't traded down there yet. Okay, so it's going to act like a big magnet. So all these fluctuations in here, without understanding what I'm showing you, it's going to feel like it's just noise. It's chop. It's not. It's actually telling you exactly what it's going to do. So the swing high here is an intermediate term swing high. So I'm going to be going short real close to this high because it's likely to break like it does here. So at 10:33, when it hits the upper end of that fair value gap, I have it now, at this moment, go back one candle. We have this high, a higher high, and a lower high. So we have a high with a lower high on either side of it. That's a swing high. That is lower than this one. That is lower than that one. So it's far more than just, oh, he's just looking at lower lows, lower highs. That's what a myopic individual would come and watch this. So like when they see me put a rectangle on the chart, they're saying, oh, it's supply and demand. It's not. There's so many more factors involved that.
Okay, let's slow down because there's a lot that's been said. A lot. But we're going to start from here. despite there being some earlier things said. I try not to write down things that I've already written down in previous episodes or things that I already know, just for the sake of a mixture of time. I won't. I don't think this will be the last time I go through the mentorship. I'm also listening to it on like 2x speed, so there is that element of I may miss some things. My ear is always keen, so I will pick up on sometimes. So sorry, I just read a comment. So I said I'd rather listen to ICT over the president. But yeah, I'd rather listen to it at this speed for now, just because I am familiar. So it's not like you're teaching a child algebra, you're teaching a professor algebra. I really know algebra, but I need to. I don't mind going over it, kind of a thing. So that being said, there's something that was touched upon that I was not familiar with prior. So I'm just thinking about how to do this because there's a lot. So let's just start with some circles, right? So the first thing I want to circle is this. Just gonna copy that. So we need one over here. Even take one here and then one. Just leave it as those two for now. It's like this. So
It's just not even in the same vicinity. Okay, so sparing all that, compare and contrast, because I've done a lot of that already on the videos on this YouTube channel. The elements of intermediate term, short term highs. I learned that from Larry Williams. Okay, that mode of deciphering market structure, he taught that in a video course that I bought back in the early 90s. And it was a video course I mentioned many times in this YouTube channel, the Future Millionaires Confidential Trading course, something to that effect. It was 4 VHS tapes. And when he talked about market structure, it kind of went over my head the first few times listening to it. Like I didn't really understand what he was showing until I started really going into the charts and saying, okay, here's a swing high. And this is how you learn it. Okay, because trust me, watching this video or watching someone else parrot what I say and then say, wow, he did it in 5 minutes, he's teaching it better. It's not jealousy me saying that. I'm telling you, you have no idea what you're doing. You're not even teaching it correctly, and those that believe that they're learning it correctly are going out there and are wrecking themselves. What you're looking at is a price chart with a directional bias. Okay, it's something that's leading to a draw on liquidity. So I've already told you last week that we were going to go below that green line. That's where we were heading. So what you're doing is you're looking at all the swing highs. And every time you see a swing high, and a swing high is simply a high that has a lower high candle to the left of it and a lower high candle to the right of it, and the one in the middle, that's your swing high. Note that. Okay, in the old days, when we printed out our charts and such, and we had chart books delivered to us, we would get them once a week. They would give us the Friday's closing data and all the daily candles. And then, until we got our new updated chart book, we had to hand draw in the open, high, low, and close on the charts, on the markets that we were following. So whenever we saw a swing high or swing low, we would just put a little ring above it, a little circle, okay, like a little halo, and that would be a short-term high. Now, I would do a double circle or double halo for an intermediate-term high, and then 3 halos for a long-term swing high. So that way, when I'm looking at price, it allows me to classify the level of high that it's forming. So it's not just lower low, lower high. No, you got to look at the nesting effect of the highs and lows. And again, that concept I learned from Larry Williams in the early 90s. He talks a little bit about it in his book, How I Made $1 Million Trading Commodities last year, which I believe is absolutely still essential reading, even though there's a lot of things in that book I think is just fluff and just like all the moon phases and things. I'm not into all that stuff. But his chapters on market structure and his $1 million trading concepts, those ideas and that premise behind it, they are still true today and they probably will always be true. So if you don't have that book, my recommendation is to get it. Go and get it where you can. I'm not going to put any kind of affiliate links up so that way you can't think I'm making any money by shilling his books. I just think it's a really good book. And at least once a year, I go through and read it just for nostalgia reasons, but I got it pretty much remembered verbatim. But by looking at that relationship of the highs, I trusted this because we had a swing high here already in effect, and I know this candle here is not likely to go above this one because this one didn't go above that one, and this one didn't go above that one. Not because it's lower lows and lower highs. There's much more going on underneath.
Okay, I'm going to make a note of that. So he's talking about looking at the context of a high. Which would entail for us to focus on the nesting effect. For example, we would need okay, so that's number one. We need to find out or understand that when you have a candlestick like this right here, this and this are lower highs than this, which is a intermittent. I said intermediate earlier. Yeah, intermittent. The intermediate is like difficulty. Intermittent is like in between, kind of. So intermittent swing high can take place on a smaller time frame if the adjacent candlesticks contain a lower high, which is like this lower high, or this extreme here, lower high, or even this. This is a lower high. So that's how we gauge the swing highs or intermittent swing highs. Why do we need to know that? Because we made an earlier point about nesting, and we are looking at the nesting of these swing highs, or should I say intermittent swing highs. And the reason why they're important is because they're going to have different characteristics as opposed to a long-term swing high on a daily time frame, for example. So yeah, that's why we made a note of
the
it.
surface than just lower lows and lower highs. That's just, it's cringy when you hear people talk like that and they try to reduce it down to something like that, or it's a support resistance idea. It's just buy the floor and sell the ceiling, okay? Or why doesn't ICT look at this trade over here and this trade? Because those trades are being referred to in hindsight by those people that talk like that. I'm literally taking live trades. I'm taking them, I'm executing on them, and I know why I'm doing it. I'm not guessing. I'm not trying to figure out or deciphering what it is after I get in a trade. I know what I'm looking for, and I know why I'm waiting for it. That is something that you learn by developing patience and trusting a model. The only way you trust it is to go through backtesting. Look at all these price action moves and start classifying the swing highs and swing lows. I will amplify what I just talked about here on Thursday's lesson, okay? Because Thursday's lesson is going to be on market structure. Okay, I'm going to teach a lot of people out there that think they know market structure. They don't really know that much at all, actually. But if this is the candle I'm trying to get in at and I execute on with all the understanding I just outlined there, I want to see displacement. And we get it here. Now, if I didn't take this trade here, I could trade with a return back to this right here. Why? Why is that possible? We have a swing high. It's broken to the upside. This low is taken out here. This candle's high here. If it touches that again, I can be short there. Just using the imbalance in the fair value gap entry technique I'm teaching you. So I can go there and get short, or I want to get up here as close as I can to that important high that I've already outlined here. So I want to be in that and wait for that initial move. Because then when this occurs, when you're that high up in the session high, So at 8:30, right there, this run up, I'm real close to this high by entering there. Notice that? I'm not waiting for a breakout below that low. So I'm getting up in there where it's an optimal entry. I don't need to get the highest high. You don't need to get the highest high. But you need to understand why it should be trading away from the levels you're trying to enter at. And that's kind of like what I'm showing you here. I'm hinting at a deeper lesson I'll give you on Thursday. But the displacement comes, which is what I was waiting for, and it gives you confirmation. When this occurs, it's just almost like, okay, just sit back and just relax and just let it do its thing. Now, Monday, again, was a holiday, so I knew I had abbreviated session hours, so I was going to close at 1 o'clock. So that's right in here. And then the next candle obviously would be 1 o'clock, and it's not trading, so it closed. But it closed here at 1 o'clock, and then the holiday session closing at 1 p.m. in New York local time, and the low, that green level here. Remember, go back to the daily chart at the beginning of the video and what we were referring to last week. The liquidity, the sell stops below this green line, that's where it was going to attack, okay? And it came in and did so. It opened up, 6 o'clock in New York time, opened up and slammed down, accelerating lower. That is the move that you want to see, being short up here and covering down below here. Once it does that and it runs into low, deep, that's it. You take your profits and move to the sidelines and then wait, because you have a big gap here. It's likely to come back and rebalance that and fill it in. And it does. And then ultimately trades around that old low and then eventually pumps up into the afternoon, consolidates, then goes into the early morning afternoon hours right there. And I showed how this set up, because after a big move, you don't want to trade in the morning session. Just don't do it. And I purposely go into a demo account to appease that desire to want to trade. So I don't burn the account. I don't take the heat off of a nice win and replace it or dampen it by taking a losing trade. In my history, in the last 30 years, I've been fortunate enough to know how I have hurt myself. Those things are the things that I like to mentor with, but those are also the lessons that everybody complains about until they lose money, and then they come back to me and they're like, I wish I would listen. So I get it. Everybody has their own interpretation of what they should be doing, how they should be learning it, but I've lived it. You're just now learning about it. So when I have a nice winning day, as you'll see, it was a nice little win. I'm not in a hurry to go back in. And then you have these days here where it can trip you up. You don't know what's going on. You don't know what's likely to occur. So I went in, I demo traded, and used, again, quote unquote, discount broker leverage to compare and contrast those fellas out there that like to work in their market replay and paper trade their stuff with NinjaTrader, and then compare and contrast what I'm doing with TradingView. So it kind of like scratches an itch, and it keeps me out of trouble with a live account, because if you catch a good lick in the marketplace and you've had winning trades, or you caught a really nice winning trade that you had to wait for the setup to pan out, when that occurs, if you're new, you have an impulsive tendency to want to go back in immediately and get that dopamine hit again. I did something right. I made money. When I was a younger man, I did that, and I had some really nice run-ups in the account, and then boom, I get a really big winning trade. And all of a sudden, I feel like it wasn't enough, because I was solo. Nobody around me was supporting me. I had no support structure around me, none. Damn. I didn't have anybody saying, hey, what you do is awesome. You don't need to worry about it anymore. So it was just me saying I had to do more. So one of the mental hurdles you're going to have to contend with is knowing when enough is enough. And when you've made money, real money, in a live account, you just won't want to rush to get back in there again. You get folks out there that sit on social media and say, you got to push your edge. No, you don't want to push your edge, because if you keep pushing your edge, you're going to dull it. You sharpen it by knowing when to get in, when to get out, and you don't dull your edge. Okay, so when I hear people talk like that, I already know they're not profitable. I know they're not profitable because they're gamblers and they want to sound like they're doing something all the time, and they're not. And if they are, they're doing it probably unprofitably. So this morning, after 9:30, again, what's the bias? Bearish. That has not changed. Even though we had this run up, it hasn't changed. So at 9:30, equities open after consolidation.
Those are the
runs up, creates a high, and then runs up again, takes out the high. That right there is your run on stops. Wait to see if it wants to break down. It does. So we're going to look at that and refer back to the video. I just put a little short video up this morning and outline the whole business. I don't want to do it here because it's just rehashing what I already showed in a very short 1 minute or so video. But ultimately, right in here, you have a nice little selling opportunity, and you can attack the fair value gap in here between the low and the high. Right there it would be. And if you want to trade with the longer term bias, you can attack the sell side liquidity resting below here and here, because they're relative equal lows. And then you've got a nice fill there as well. So I teach in a manner that allows my students to pick, number one, the style of trader they want to be. They want to be a day trader, they want to be a scalper, they want to be an intraday swing trader. If they want to be a short-term trader where you're holding overnight, or if you want to be a daily chart swing trader or 4-hour chart swing trader where you're holding for a week or more, or if you want to do a position trader, which to me is I don't have that mentality to do that. I have too many things that show up on a chart that make me change my mind all the time. So I have a lot more opportunities because I think short-term and I excel in short-term. That does not mean that is not a proper way of trading when it's position trading, because I don't match that personality-wise. So I like to excel where I'm strongest, and it's in intraday trading, and I can run the account pretty quick with velocity. I can get short-term moves and just parlay them up real quick, which is kind of like what I was demonstrating facetiously this morning with the 1 minute video. Thumbing my nose at the quant. So we're looking at the likelihood of...
Okay, so I'm looking at this chart and then this chart, and we have two different behaviors. On this chart, we have from 8:30, which is right here. We have this move up, which is fine. We create this high, come back down, but we come back up close to the high. But he enters in over here at 11:33, he said, which would be, I believe, just 3 minutes. So it's 27, 30. So you got it in right here. But I'm not sure what his exact definition is because technically you do take out lows here. My point is this, that this is a run up. We have a retracement. And we have this high over here. I guess to be fair, we do have swing high. How do you have a swing low then? Is it the same thing? For example, this is a swing low. This is a swing low right here. So why did he get in here? Because if you see this, he's telling us, I'm assuming, to get in around about after this second high. But they're so different. Okay, we're going to make this last episode because I want to get this down. So
trader, which to me is I don't have that. I like that one. Maybe even if we get really excited, we can trade down into 12,000s, 12,850, 12,875 in that area. So just something to think about. I'm not suggesting you should take a trade in it or not, but just thinking out loud. This lesson obviously was a little bit fast and loose, and will be a lot more structured on the market structure lesson on Thursday. Hope you found this one insightful, and I'm going to show you again. This was a trade I took with a live account. All right, so I'm going to log into my TD Ameritrade account. I'll show you a result of a trade I took yesterday. I've not taken any live trades today. Again, this is just to show real executions are being done.
22nd of second into 26th.
Just names of folks are just really hardline critics. I just want to know. Can I push the button? Push the button, CG. All right, so here is the business for last 6 days trading. And again, this account is just to show what I believe a student could do. Now, right away, look at this right here. This is not a losing trade. It looks like negative $2,700.55. What that is an adjustment by the broker because at the time of settlement, when I closed the trade, it showed that I was up $4,920. And because of their accounting, they were just showing that they were reflecting a gain of $7,675, which is not the actual realized result for me. It was them doing their administrative side. It's a broker thing. Trust me, I cannot do anything to make that happen. It's not me doing some funny money business. Okay, anybody that trades with live funds, they've probably seen this happen in their own account. So over here, you can see the execution yesterday. I had a scratch where I got in a little too early, was a little ambitious, and in the second one, I wasn't sure if it was going to go higher or lower. And just to appease my curiosity, I threw a short in just to see what we'd get. Snapped against me a little bit, not much, but still enough to get my attention. And I knew what I was looking for. So there's the short that is outlined in the previous portion of this video. Wrote all that down, held for the gap opening after reopening at 6 o'clock, and there is the close of the trade right there. Nice little dandy, $4,920 fixes the little pinch I took on the one trade earlier in the day. And one scratch was nothing, it was covering costs. Okay, and again, there's the business there. That's the entry, and that's the exit. And there's no commission cost on the one above that. So you can see that was not a trade. Hope you found this insightful, and I'll talk to you on Thursday. Be safe.
Because it's basically just showing that you took the trades live. Hold on.
And eventually pumps up into the afternoon, consolidates, then goes into the early morning afternoon hours, right there. And I showed how this set up, because after a big move, you don't want to trade in the morning session. Just don't do it. And I purposely go into a demo account to appease that desire to want to trade. So I don't burn the account. I don't take the heat off of a nice win and replace it or dampen it by taking a losing trade. In my history, in the last 30 years, I've been fortunate enough to know how I have hurt myself. Those things are the things that I like to mentor with, but those are also the lessons that everybody complains about. Until they lose money and then they come back to me and like, I wish I would listen. So I get it. Everybody has their own interpretation of what they should be doing, how they should be learning it, but I've lived it. You're just now learning about it. So when I have a nice winning day, as you'll see, it was a nice little win. I'm not in a hurry to go back in. And then you know what's likely to occur. So I went in, I demo traded, and used again, quote unquote, discount broker leverage to compare and contrast those fellas out there that like to work in their market replay and paper trade their stuff with Ninja Trader, and then compare and contrast what I'm doing with TradingView. So it kind of like scratches an itch, and it keeps me out of trouble with a live account because if you catch a good lick in the marketplace and you had winning trades, or you caught a really nice winning trade that you had to wait for to set up the payout, when that occurs, if you're new, you have an impulsive tendency to want to go back in immediately and get that dopamine hit again. I did something right. I made money. When I was a younger man, I did that, and I had some really nice run-ups in the account, and then boom, I get a really big winning trade. And all of a sudden, I feel like it wasn't enough because I was solo. Nobody around me was supporting me. I had no support structure around me, none. I didn't have anybody saying, "Hey, what you do is awesome. You don't need to worry about it anymore." So it was just me saying I had to do more, and they're not. And if they are, they're doing it probably unprofitably. So it has not changed. Even though we had this run up, it hasn't changed. So at 9:30, equities open after consolidation. It runs up, creates a high, and then runs up again, takes out the high. That right there is your run on stops. Wait to see if it wants to break down. It does. So we're going to look at that and refer back to the video. I just put a little short video up.
Why is this? Excuse me. Why is this not on the stock? Because basically what I'm trying to find out is with this, I can see. I mean, with this one, sorry, I can understand it. We had a high that we created over here that took out this stops. We then have a market structure break to the downside, taking out some of these lows, and we have a retracement back into the imbalance, and then we take the sell, the trade. Here, well, we're bearish, right? So what do we see? We see price open. We have a run up, which is the manipulation, taking out this liquidity over here. We then have a push to the downside. We have some displacement, right? And we trade back into displacement. And then if I had taken the trade, I would have lost because price went up again to take this one out. So my consideration is, in this case or this situation, we didn't take out the previous high. Here we took out the previous high. Here we made money. Here we would have lost money by the standards of entering in the same trade or same style here. So I'm trying to figure out the difference between the two, because this one took out this high over here. This kind of move took out these highs over here. So it's like, you know,
this morning and outlined the whole business. I don't want to do it here because it's just rehashing what I already showed in a very.
it doesn't really explain this. So I can't include it. So he did kind of say that he's going to, on the next episode, kind of go into detail. So it's going to be this episode. So what I'm going to try and do is do this stream. I'm going to do the second stream today when I come back from my prayers at church. I want to then come and fully realize this, because this is a very good one as well. Market structure. Oof. That's a good episode to watch. That's episode 12. We have another big one after that, which is episode 13. 14, 15, 16, 17. We've got two big ones here. And after that, it's chill for pretty much the rest. So we look forward. I think we got this. It's quite easy. We did have a little patch where we were a bit slow, but it's fine. We just completed another episode today, and we're going to continue today evening. Update on the website. I haven't really done much updates for At the Edge. I've been focusing on the other business we're building. This one, there hasn't been many changes since the last time, but it's still extremely useful. In terms of social media, last week I did a whole project at one of the properties for At Homes. So I wasn't able to really do anything, which is this property right here. Oops. You can see, I don't know if it shows any of the bedrooms. Yeah, it's my laptop. It's not my hands though. Why is it doing the line properly? Okay, some of the pictures are here. All right. So we changed the beds. You can see it's this like metallic bed. Now it's got like a nice suede backdrop or headboard. The beds are thicker. The mattresses are thicker, more comfortable, and everything else I think is quite good. But yeah, it's a lot better. We changed two of the beds. We did some of the repaints on some of the bedrooms, not this bedroom, the other bedroom, and then the living room. We also cleaned the rug. We had a carpet cleaner. We then also rearranged the cleaning cupboard, changed it from plastic containers to boxes. And we did some gardening. And what else did we do? We want to change the dining table. It's currently glass, which people are complaining about, because when you clean it, sometimes, unless you use a glass cleaner and squidgy, if you just clean it with like a cloth and spray, it leaves marks, but it's not dirty. It's just not aesthetically pleasing. So yeah, I'm trying. I think this website could do with upgrade as well. So that's on the list of things to do. But this website hasn't done much. The business that I need to somehow finish in the next 10 days. I have genuinely no idea how. But we got to do what we got to do. That one, I'm not even sure. But anyhow, we just got to go take each day as it is. And I don't even know what I'm going to do for May either. I don't really like any of the ideas I have right now. So, anyway, it's me with CJIC. We'll probably see you guys later today. Very, very high chance of that happening. And we'll continue on from episode 12. And then we can accomplish that. So, yeah, thank you guys for showing up. We'll be back tomorrow. I got to go get changed soon. And I'll see you guys later. Peace.